Here from Glorious Can, unfortunately with a bit of a warning. What's the warning? Look, stock market is up 6.6% since the beginning of the year. Glorious, right? Amazing. But look back 6 months, we're basically flat. We haven't really done anything at all over the last 6 months. And why is that? Well, who is in this rally and who isn't? Hedge funds are not part of this rally. They tend to be a little bit the smart money, and they've got tons of it that isn't deployed. So you could say, well, that's glorious. They're going to join in, and the rally's going to go further. Possible, but also possible that they don't. Secondly, if you look at the stocks that are shorted, they are still very, very much shorted. And generally, the guys who short, you might think they're a bunch of idiots and clowns and you loathe the Citadels and all these hedge funds. But in reality, they are actually fairly smart and they made a load of money. I mean, Citadel made, 16 billion last year, right? In profits, best hedge fund year of any hedge fund ever in the world. So you think they're getting burned on the whole Reddit thing and the AMC stuff and something? No, they're not. They're making a boatload of money. So when they give up shorting, you're in a really, really, really bullish market, and they haven't. Kind of worries me. Second part of that story is, and there's a third part of the story as well. Second part of that story is that forward guidance on earnings is coming down. So we basically know that profits are not going to grow at all or going to grow less than expected in 2023, 2024. So therefore, unless stocks fall in price, they're becoming more overvalued. So a flat stock market still means that they're more expensive, because in previous years we were expecting higher growth in the coming years, and the market values on forward-looking earnings, not on past numbers. So that worries me, because earnings is really the fundamental driver of it all in the long run, not in the short run, but in the long run. So that's going to cap our rally potentially a little bit. And then there is a little man, and he's called Jay Powell. He's not a little man, he's the chairman of the Federal Reserve. We should have respect for the office and all that. And he speaks on the 1st of February. And he doesn't just speak, but he also is going to increase rates, very likely by 0.25%. And a lot of the market might be like, woohoo, that's amazing, but the Fed fund market, the Fed fund futures have priced that in. 97% or something like that of the market are basically saying, yeah, we're going to get a 0.25% hike. So, is that therefore going to have any impact? Well, what really matters is what he's going to say. And if I were him, I'd be furious, absolutely furious. I'd be throwing my embroidered slippers at my manservant, because the financial market has completely undone all the good hard work of those Fed presidents by raising rates. We've basically undone the last 3 percentage points of interest rate hikes. How? Financial conditions are super easy. Right? The market's done well, reasonably speaking. We're flat over the last 6 months. We should be down significantly with all the rate hikes. The bond market seems pretty chilled. Lending is okay. Everything seems kind of all right. And therefore, he's going to have to come out, and he's going to have to dust off his Jackson Hole speech, which tanked the market, if you remember that, in November, and he's going to have to find some tougher words. He's probably sitting there with a thesaurus, trying to figure out, words to tank the market. That's, if I were Fed president, which of course I'm not and I never will be, nor do I have any ambition to be, and I probably shouldn't be, I'm not qualified, but yeah, that's what I would do. So that's kind of what I'm looking at for the first. So watch out for that date. That's really what I would say. Now, what about the longer term strategy for this year? Well, one, come and visit the beautiful resorts of the south of France and the coastline here. There's a reason the Brits came here in the 19th century, because it's amazing in the winter. It really is. And secondly, is it a good time to buy quality stocks? Yeah, I would say so. I would say it's a good time to buy quality stocks. It always is. But stocks are now cheaper than they were a year ago, so that's a good thing. And therefore, I would continue to buy good quality stocks. The one thing that's also done really, really well is non-profitable tech, right? They have an amazing start to the year, which probably wouldn't have expected. I probably would have expected that to happen maybe in 9 months' time. So I'm not a huge believer in this rally. I suppose that's what I'm trying to say in a lot of words. I'm sorry about that. So I'd be a little bit cautious. I would be a little bit cautious. Now, let's see what comes out of the 1st of Feb. And then after that, let's see what the Fed keeps saying after that. Because really, they're going to watch the market response, and then they're going to respond further. And remember, even though they're slowing rates, they are still shredding more money than anybody has ever shredded before with quantitative tightening, which is the equivalent of several rate hikes. So they can basically stop rate hikes, maybe in March, maybe in May, and still put some serious pressure on markets. And the market has traditionally only ever gone up when there was money printing. For the first time ever, pretty much in history, we're destroying money. So it's going to be an interesting space to watch. So how are we going to make money out of it? I'm going to be a lot more active on trading. That's essentially what my plan is for the year, because I think the market's going to be, I think the market's going to be disappointing, but that's just my view here. I'm not a pessimist though. We're going to enjoy the beautiful day here, the beautiful palm trees. We've all just been to the beach down there with little Winston. And I wish you a beautiful Sunday wherever you are.